In the early stages, everything looked fine. Markets were calm. Prices were high but justified. Experts appeared nightly to explain why this time was different. That phrase has always been dangerous. Every major collapse in modern history has been preceded by the same belief. That old rules no longer apply. In the late 1920s, it was called a permanent plateau. In the early 2000s, it was innovative financial engineering. And this time, it was controlled risk and soft landings. Different words, same mindset. The system didn't feel fragile. It felt optimized. Too optimized. Power built on leverage. True power in modern economies doesn't come from ownership. It comes from leverage. Leverage allowed institutions to control enormous value with very little actual capital. It amplified gains. It also quietly amplified risk. But risk didn't look dangerous, because for years it didn't punish anyone. Cheap money reshaped behavior. Borrowing stopped being a temporary tool and became a permanent strategy. Debt was no longer something to manage. It was something to rely on. And when everyone relies on the same assumption, the system becomes synchronized. That's when collapses become inevitable. Not because of malice, not because of stupidity, but because incentives stopped aligning with reality. Strategic decisions that changed everything. Every collapse is built from a series of rational decisions. Lower interest rates weren't reckless. They were stabilizing. Emergency stimulus wasn't irresponsible. It was necessary. Relaxed lending standards weren't careless. They were competitive. Each move made sense on its own. But systems don't collapse from single decisions. They collapse from direction. And the direction was clear. Short-term stability over long-term resilience. Resilience doesn't generate headlines. Stability does. So stability was chosen. Again and again. The early cracks. The first cracks didn't show up where people expected. They didn't appear in stock indexes. They didn't appear in unemployment numbers. They appeared in behavior. Buyers hesitated, but not loudly. Sellers adjusted expectations, but slowly. Institutions quietly changed models. Nothing dramatic. Just friction. Transactions took longer. Inventory stayed visible a bit too long. Forecast required more assumptions. These are the signals historians always point to later. At the time, they're dismissed as noise. Why collapses are invisible at the start. Human systems are bad at recognizing slow failures. We are trained to respond to shocks, not erosion. A bridge doesn't collapse because one bolt fails. It collapses because thousands of small stresses were ignored. Economic systems behave the same way. By the time stress becomes visible, structural damage is already done. That's why collapses always feel sudden. Even when they were. The collapse had already begun. People just didn't agree on what they were seeing. Confidence is always the last thing to break. Confidence is sticky. It survives bad data. It survives warnings. It survives history. Because confidence isn't built on numbers. It's built on memory. And memory said, "We've survived worse." That belief has ended eras. The quiet shift. Behind the scenes, strategies changed. Risk departments tightened models. Lenders added conditions. Investors demanded higher returns for the same exposure. Not panic. Adjustment. But when adjustments happen everywhere at once, liquidity dries up. And when liquidity dries up, prices stop being negotiable. They become fragile. The point of no return. There is always a moment, invisible when it happens, where recovery becomes impossible without pain. That moment doesn't feel dramatic. It feels boring. And by the time it's recognized, policy tools lose effectiveness. Not because they're wrong, but because timing matters. And timing was missed. The collapse didn't announce itself. It slipped in quietly, wrapped in rational decisions, protected by confidence, and ignored by those who expected chaos to be loud. So when people ask, when did this start? The honest answer is uncomfortable. It started when stability became more important than strength. And once that choice is made, history only moves in one direction. The trap was never designed to hurt anyone. That's the uncomfortable truth. No closed-door meeting ended with a decision to cause collapse. No strategist sat back and planned failure. What happened instead was far more human and far more dangerous. The system rewarded the appearance of strength, not the reality of it. And over time, that distinction stopped mattering. Power always follows incentives. To understand why the trap formed, you have to understand how power actually works. Power doesn't respond to warnings. It responds to incentives. If a decision produces growth, approval, and stability today, and risk tomorrow, tomorrow almost never wins. That's not corruption. That's structure. Institutions are not built to think in decades. They are built to survive quarters. So strategies evolved accordingly. Short-term wins, long-term fragility. Every strategic move shared the same logic. Reduce friction. Increase participation. Keep momentum alive. More access meant more volume. More volume meant more growth. More growth meant validation. And validation silenced critics. When early warnings appeared, they weren't ignored outright. They were reframed. Risk wasn't increasing. It was being distributed. Debt wasn't dangerous. It was being managed. Exposure wasn't concentrated. It was being optimized. Language softened reality. That's how traps are built. The rise of systemic dependence. At some point, the system crossed an invisible line. Growth stopped being the result of healthy demand and started becoming the result of support. Support from policy. Support from credit. Support from expectation. And once a system depends on support, removing it becomes impossible. Not because it would fail, but because it would reveal how fragile things already are. So support stayed. Longer than planned. Larger than intended. Strategic blind spots. The most dangerous blind spot was consensus. When everyone agrees, dissent looks irresponsible. Voices that questioned sustainability weren't silenced. They were marginalized. Not because they were wrong, but because they disrupted confidence. Confidence had become a strategic asset. Lose confidence, and the entire structure shakes. So leaders learned to protect it, even when protecting confidence meant postponing reality. Why corrections were feared. Corrections are healthy. They reset expectations. They release pressure. They prevent extremes. But corrections are politically painful. They produce headlines. They upset voters. They hurt balance sheets. So instead of allowing small corrections, the system absorbed pressure. Year after year. Pressure doesn't disappear. It accumulates. Leverage became invisible. As leverage increased, it became normalized. What once would have seemed aggressive became standard practice. Models adjusted. Benchmarks shifted. Risk thresholds expanded. Not because anyone demanded it, but because everyone else was doing it. That's how systemic risk hides. It doesn't feel reckless. It feels competitive. The comfort of data. Data became a shield. As long as charts pointed upward, as long as metrics stayed within acceptable ranges, decisions felt justified. But data only reflects the past. It cannot warn you when the structure underneath it is weakening. And by the time data changes, momentum has already turned. That's the illusion numbers create. The moment flexibility was lost, there is always a point where flexibility disappears. Options narrow. Reversals become expensive. Admitting mistakes becomes destabilizing. That moment doesn't arrive suddenly. It arrives quietly, when every alternative looks worse than continuing forward. That's when the trap closes. Who benefited while it built? Power concentrated during this period. Those closest to liquidity. Those with access to cheap capital. Those able to move first. They benefited the most. Not because they caused the trap, but because the system rewarded proximity. Meanwhile, risk dispersed downward. Quietly, gradually, efficiently, until no one could trace where it truly lived. Why warnings failed? Warnings failed because they lacked urgency. They spoke in probabilities, in scenarios, in footnotes. But collapses don't begin with certainty. They begin with discomfort. And discomfort is easy to ignore, until it becomes unavoidable. The illusion of control. Perhaps the most dangerous belief was this: that the system could be adjusted at will. That tools existed for every outcome. That timing could always be managed. History has never supported this belief. Complex systems don't respond linearly. They respond emotionally. And once trust weakens, policy loses power. The trap fully set. By the time concerns became mainstream, choices were already constrained. Intervention risked credibility. Inaction risked exposure. Either way, pain was guaranteed. The only question left was who would feel it first. The collapse wasn't caused by one bad decision. It was caused by 1,000 good ones, made in the same direction. This is how traps work. They reward cooperation. They punish hesitation. And they only reveal themselves when escape is no longer possible. In the next part, we look at the moment the numbers stopped cooperating, and why, once they did, the story could no longer be controlled. Numbers don't panic. They don't speculate. They don't care about narratives, elections, or reputations. They only reflect reality. Eventually, for a long time, the numbers cooperated. Or at least, they appeared to. When metrics lag reality, every system has lag. By the time data confirms stress, stress has already existed for months, sometimes years. That lag created comfort. As long as indicators stayed within acceptable ranges. Leaders believed time was on their side. But lag cuts both ways. When numbers finally move, they move all at once. And when they do, explanations stop working. The first honest signals. The earliest honest signals were subtle. Margins tightened. Spreads widened slightly. Forecast ranges grew larger. Not red flags, yellow ones. But yellow flags are easy to ignore when nothing has technically gone wrong, especially when the cost of acknowledging them feels higher than the cost of waiting. Adjustments that revealed weakness. Small adjustments exposed something uncomfortable. When assumptions were tweaked, just slightly, outcomes changed dramatically. That's when concern turned quiet. Because systems that are healthy do not collapse under minor stress. Fragile systems do. The day models broke. Every collapse has a moment. When models stop agreeing with reality. Inputs still look reasonable. Formulas still work. But outputs stop making sense. Predictions miss. Ranges explode. Confidence intervals become meaningless. At that point, the math hasn't failed. The assumptions have. Why this moment is always ignored. This is the most dangerous phase. Because nothing has technically happened yet. Prices still exist. Transactions still occur. Institutions still function. But beneath the surface, trust in the numbers erodes. And when decision makers stop trusting their own data, they stop taking risks. That's when motion slows. Liquidity begins to thin. Liquidity isn't about money existing. It's about willingness. The willingness to buy. The willingness to lend. The willingness to commit. When uncertainty rises, liquidity doesn't vanish. It hesitates. And hesitation is enough. The quiet freeze. Deals took longer to close. Approvals required more layers. Terms grew stricter. Nothing dramatic. Just enough friction to change behavior. When behavior changes everywhere at once, systems stall. Why this phase feels confusing. From the outside, it looks like nothing is happening. From the inside, everything feels heavier. Effort increases. Results shrink. Confidence weakens. That disconnect confuses observers. Some call it temporary. Others call it cyclical. Very few call it structural. Because structural problems demand structural solutions. And those are never easy. The narrative starts to crack. At this stage, narratives multiply. Optimists point to resilience. Pessimists warn of danger. Officials emphasize patience. Everyone uses numbers. But they're no longer using the same ones. That's when trust breaks, not in outcomes, but in interpretation. The moment psychology shifts. Collapses don't begin with data. They begin with psychology. The moment participants stop asking, "How much can I gain?" and start asking, "How much could I lose?" everything changes. Risk tolerance shrinks. Time horizons shorten. Safety becomes priority. That shift is irreversible. Why corrections become cascades. When participants move simultaneously toward safety, prices don't adjust smoothly. They gap. Because there are fewer buyers. At every level. This isn't panic. It's alignment. And alignment is powerful. attempts to restore confidence. At this point, reassurance becomes louder. Statements emphasize strength. Reports highlight positives. Language becomes careful. But reassurance only works when trust already exists. Once trust erodes, words lose force. The illusion of just one more adjustment. This is when the system tries one last thing. A tweak, a pause, a recalibration. Because admitting the scale of the problem feels more dangerous than attempting control. But control at this stage is mostly symbolic. The point where momentum takes over. Momentum is neutral. It doesn't care about intention. Once it turns, effort is required just to slow it, not reverse it. That's when outcomes stop responding to strategy. They respond to gravity. The numbers fully honest. Eventually, the numbers align. Across sectors, across regions, across expectations. When that happens, denial becomes impossible. Not because of headlines, but because behavior has already changed. The collapse becomes visible only after it has already reshaped decisions. This is the moment history later points to, not as the beginning, but as the confirmation. The point when the numbers stopped protecting the story. And once numbers tell the truth, the story ends quickly. By the time people ask how to stop a collapse, they are already asking the wrong question. Collapses are not events. They are processes. And processes don't respond to urgency. They respond to structure. By this stage, the structure has already changed. Why intervention loses power. Intervention works best early. When confidence exists. When trust is intact. When behavior is flexible. None of those conditions remain. Tools that once stabilized now create side effects. Signals that once reassured now raise suspicion. Every move is interpreted, not as leadership, but as desperation. That's not perception. That's psychology. The cost of reversal becomes too high. Stopping a collapse requires reversing incentives. But reversing incentives means accepting pain. Pain for institutions. Pain for markets. Pain for credibility. And credibility, once lost, is almost impossible to rebuild quickly. So leaders hesitate. Not because they don't see the problem, but because they understand the consequences. Why waiting feels safer than acting. Action creates accountability. Waiting creates ambiguity. And in fragile systems, ambiguity feels safer. If outcomes worsen, they can be blamed on momentum. If action fails, it becomes a decision. That distinction matters. So delay becomes strategy. The illusion of control one last time. At this stage, control is mostly theatrical. Announcements are made. Plans are outlined. Frameworks are discussed. But beneath the surface, behavior doesn't change. Participants already adjusted. They're protecting capital. They're reducing exposure. They're shortening timelines. No announcement can reverse that. Why confidence does return on command. Confidence isn't logical. It's emotional. It's built through consistency, predictability, and trust over time. Once broken, it doesn't respond to explanation. It responds to experience. And experience is now negative. The role of memory. Memory shapes behavior more than forecasts. Those who lived through previous collapses recognize the pattern. They don't wait for confirmation. They move early. That movement accelerates outcomes, not because of fear, but because of experience. When self-preservation becomes rational. At this point, self-preservation isn't panic. It's strategy. Holding less risk makes sense. Waiting makes sense. Avoiding leverage makes sense. When rational behavior produces negative outcomes for the system is already broken. Why stabilization can't restore the past? Even if stabilization occurs, it doesn't undo damage. It freezes the current state. And the current state includes lower trust, higher caution, reduced participation. That becomes the new baseline. Growth doesn't resume where it left off. It resets lower. The difference between collapse and collapse myths. Collapse isn't everything failing. It's expectations resetting. It's power shifting. It's behavior changing. Most institutions survive. Most systems continue. But they operate under new rules. And those rules are stricter. Who adapts, who does. Collapses don't destroy everyone equally. Those with flexibility adapt. Those with leverage struggle. Those dependent on constant growth suffer. Those built for volatility endure. This is how power redistributes. Quietly, without drama. Why recovery takes longer than anyone admits. Recovery requires trust. Trust requires time. And time is the one thing no collapsing system has patience for. Shortcuts don't work. They never have. History is consistent on this point. The most dangerous misunderstanding. The biggest mistake is believing collapse is failure. It is. It's correction. A painful one. A slow one. An unavoidable one. Systems that avoid correction don't become stronger. They become brittle. What happens after acceptance? Once acceptance replaces denial, adaptation begins. New strategies emerge. New priorities form. New power structures take shape. This is not the end of history. It's the end of an assumption. The final truth. The collapse can't be stopped. Because it already happened. Where it matters most. In behavior. In trust. In decision-making. Everything visible now is just the echo. It will ask, why so many believed? They still had time. Because collapses don't punish ignorance. They punish delay.